Okay. So when a syndicator is doing smaller deals that the raise, even a $5 million raise, that would put them to be possibly a 15 million dollar deal, right? Which is
Yeah.
still a sizable deal. What would you say are the advantages and disadvantages of using the investment club model versus a normal syndication model?
Yeah, the way I see it is I don't think you ever need to pick one or the other. We work with a lot of people that run funds and syndications, and then they also run investment clubs in parallel. And the way they think about it is they want to unlock pretty much all aspects of their audience and run it at scale, right? So that's why, Tim, when you mention people with a community or people that, are developing their social presence, for example, right? A lot of times your community or the audience you're attracting, they're not necessarily going to be very wealthy accredited investors or family offices, right? They could just be normal people that have 10K, 25K, 50K, right? Just like a tier lower than what your traditional syndication might be, but value in being able to capture that set of the market and potentially convert them into a syndication or fund down the line. So that's one aspect that we see it.
Mm,
And then the second one, it really comes down to marketing. We've had a lot of very sophisticated operators choose to do an investment club because when they're publicly talking about their club, because it's not a security, right? You have more freedom to talk about what you're doing in the club. It does signal to everyone that consumes your content that you are actively raising money. So people have
yep.
raised 6 to 7 figures for their club. And then because they're marketing their club, they also raise 7 figures for their fund or their syndication. And last week I was talking to one of our clients, Brand Brenham, and he was saying like a lot of people saw him posting on Facebook because he was marketing his club, and they were like, "Whoa, Brandon, we didn't know that you're raising money again. Like, why didn't you tell us? Can we still invest in your fund?" So he wasn't even like marketing for his fund, but because he had more room to just talk about what he's doing with the club, he ended up raising money for both sides of the legal structures. And I thought that was a really cool way to really leverage the advantages that you get from a club and then have it fit
Right.
the different parts of your legal structures.
I like that. I like that a lot. Yeah. One of the attorneys that I've interviewed a couple of times on the show, Nate Dotson, he has a crowdfunding platform, RegCF platform, and he structured something very similar to that because with a RegCF, you can advertise, you can talk to anyone, accredited or non-accredited, and yeah, and so starting that conversation then leads, depending on if they're non-accredited, takes them to the RegCF. If they're accredited, take them to the 506C. So it's a similar kind of idea here that you have. I like that a lot. And in terms of like you mentioned that with the club, you are able to raise money ahead of time before you even start looking for properties, before you even get a property in a contract. So it's you're raising it based on your business thesis, right? So similar to the advantages of a fund, a blind pool fund where you can do that you can't do with a syndication. I like that a lot. Can you touch on that a little bit?
Yeah, definitely. And I'll share a case study here, which I thought was really interesting. So, we recently worked with some of the folks here in commercial might know, investor girl Brittany Arneson. So, they are very focused on hotels and self storage. And at one point, they had found a hotel, set up a 506C for it, and then actually already raised deposits for that specific hotel. And then during due diligence, they realized that this deal was not going to work. So basically, the deal fell through. They built their 506C documentation on that specific deal. Plus, they've already collected deposits from a bunch of people in their network that are just really bullish in general about hotels, right? So they're like, okay, we don't really want to give up this money because we've already raised it. What do we do next? And then while this was all happening, they find hotel deal number two, and it's got a really tight closing date. And also in the back of their head, they're thinking, if we did another 506C for hotel deal number two, what if hotel number two also falls apart doing due diligence? Now we gotta go make another 506C for hotel deal number three, and it's just not scalable. And that's when like the investment club made a lot of sense for them because all these people, they just primarily want to invest in hotels, right? They're not not so particular about deal 1 or 2 or 10, right? We just really love hotels. We really want to invest with you, Britt. And that's why they ended up creating a hotel investment club with a specific buy box, right? You still have to be pretty defined on what kind of properties you want to target. So they made the club instead. And then now we can look at deal number 2 and vote to approve. If deal number 2 doesn't work out, you don't have to build another club, right? Your buy box and your club and all the investors, they still stay intact. You just find another deal, look at that, and decide whether or not you're going to deploy money into that. So that's why I think being able to raise money for a criteria with or without a deal, like not having it tied to a specific deal, is a more strategic approach if you're someone that has a decent amount of deal flow and you have options where you don't need to be tied to a specific project.
I like that a lot. Okay. Yeah. And then share with us one of the things that you touch on when we talked before this interview, your process of requiring the investors to put a deposit that holds them to be able to perform or they lose their deposit. Because one of the challenges that we have in the syndication space with the soft commits is that sometimes they don't go through with the soft commits. And depending on the market, if there's a lot of uncertainty in the marketplace, we see a higher percentage of LPs who soft commit and then back out. And so touch on that. Let's dive deeper into how your platform works and regarding that, and also what are all the fee structure too.
Yeah, definitely. So, exactly to your point, Tim, like I got burned myself raising money where people gave me all sorts of verbal commitments and then just completely disappeared out of thin air when it was actually time to wire the money. So, I was like, never again. How do we prevent this? And we took inspiration from sellers needing an EMD, right? We were like, why isn't the concept of an EMD more common when it comes to raising capital? So, the way that we design our platform is when someone joins your club and says, I'm going to invest 50K, it's not a verbal commitment. They actually have to pay fractionals transaction fee, which is 3% of whatever they're investing, as a way to lock in their spot in your club. So then if you hit your race target, everyone is good and everything is moving forward, and for whatever reason, that one investor decides to flake and not invest, they're going to lose that 3% transaction lock-in fee that they paid. And nobody wants to lose money, right? So it really enforces them to have skin in the game when they say, I do want to join your club. We ask them, okay, put your words where your mouth is at, right? Leave that transaction fee. So that's really just significantly decreased the flake rate on the platform. We rarely see it happen because people are really committed and they're financially tied, right? When they say, I'm investing 50K, I'm investing 25K, they're putting that 3%. So that's how we've turned a soft commitment into more or less of a hard commitment. And then in terms of how pricing works, so we have a setup fee that is $3,500 for us to basically turn your criteria, turn your deck into a compliant investment club where we make sure you have all the right pieces in play and this isn't accidentally a security and all those things. And then when your raise is successful, that $3,500 is actually credited back to you. It's mostly there just because we're putting in a lot of work to set up your club and we want to make sure like you're actually serious in wanting to run this club. So that's the setup fee. And then when your investors join, they pay a 3% transaction fee off of their investment. And that covers us creating the LLC, building the operating agreement, all the payment processing and money movement is happening on the platform. And then we also do identity verification on all the investors to make sure everyone is who they say they are. So that's what each investor is paying. That's not a cost to you. And then we do everything back office too. I know no one wants to be a full-time CPA or accountant, so you don't have to deal with any of that. We automate all of the profit distribution. So we calculate whenever we have a distribution or there's profits, we calculate pro rata how much each investor should get, and we'll automatically send it to their bank account. We file taxes for the investment club as well. And then we also create K1s for every single investor. So it effectively saves you from having to have a full-time accounting team or working with another full-time CPA. That's pretty much all covered in-house by us. And that is $3,500 annually for the entire club. Doesn't matter how many people you have in the club, doesn't matter how many deals your club is doing. It's always a flat $3,500. And usually we see the club leader paying that while the investors pay the 3%. That's one time.
I see. Okay. And on the default, meaning they don't move forward, they do their deposit but don't move forward. Does fractional keeps that money? Does any of that money goes back to the club leader at all?
It's just fractional. It's effectively
Okay.
they're paying for our transaction fee.
I understand. Okay, that's good. So yeah, it sounds like the process to start your club is pretty easy, pretty straightforward. Fees are minimal. I like how the bulk of the fees is charged to the investors itself. So that way the club leader doesn't look like their club is very fee heavy. Yeah, okay, very good. All right, Stella, I know I put the link to your website on the chat, but for those that are listening to this on audio, if they want to learn more about fractional, maybe reach out to you, whether to interview you or do collaborate with you somehow, where would you like to send them?
Yeah, let me drop my Blink card in the chat as well. That way everyone has my information. That's my Blink card. And then my email is just stella@fractional.app. Super simple. Tim dropped our website, fractional.app. Definitely find me there.
Great. Okay, real quick before we open up for Q&A, I know you mentioned to me previously you raised about 20 million to for fractional. Share with us, how did you do that? Who did, was it all VC money? Was there any sort of friends, family money? Give us an insight into what it's like to raise money for a startup.
Yeah, it was honestly a very chaotic yet fun experience. So we started Fractional January of 2021. So we officially pretty much just hit our 5-year milestone, which is very big for me personally.
Wow,
And
congratulations.
thank you, thank you. So we started out as a Y Combinator company. So Y Combinator, they were the first check into the business, and it's a very big deal for any startup founder because YC basically created all the legendary businesses out there, right? Airbnb, Stripe, DoorDash, all of them came from Y Combinator. So they were our first check, and it definitely helped a lot with just giving us more visibility, all that. And that's actually how our council found out about us. That was also a very interesting experience where I randomly got a call from Zach, who was the former senior counsel of the SEC, and he was like, "Hey, it's Zach. I'm from the SEC. Give me a call back." I literally thought we were in huge trouble, but luckily he really believed in what we were doing and now is our legal advisor and helps us and all of our clients be compliant. So that was a very scary moment, but turned out for the best way possible. I always love sharing that story. But yeah, from YC, we started building the initial MVP. We launched, I think, 10 clubs initially within the first 3 months of starting out the business. And then demo day is what YC does, where you basically come out, you pitch a room of 100 VCs. Think about like Shark Tank, but in real life, essentially, right? And if people like you as a founder and they like the early traction, they'll decide that they want to be seed investors in the business. So we, at first, on top of YC, raised $5 million from CRV. They led DoorDash's round in the past. And then also Will Smith and Kevin Durant. They really loved like the whole community aspect that we were building. So they joined in that round. And then from there, we built a team. The business started growing even more. And then more recently, we raised $15 million for our Series A from Fifth Wall. They're the largest VC in real estate. So it's been like every day is very new. There's always more things to work on. I always say like myself and the business, like we're always a work in progress. And I am like always just so fired up, even as an investor too, like seeing all the cool projects that everyone gets to work on. And sometimes it's fun to double dip where I'm like, whoa, that looks really cool. Can I join your club? So it's been an incredible experience.
That's amazing. Congratulations to, yeah, reaching 5 year and yeah, definitely all the success you have had so far. It's amazing.
Thank you.
Yeah, I really appreciate you, Stella.
Of course. Thanks for having me. That was a blast. Appreciate everyone here.